Stock Daily Insights. Your daily market compass.
Today is Wednesday, September the 11th, and the U.S. stock market saw a collective rise across the major indices. The S&P 500 gained over 1%, the Nasdaq surged more than 2%, while the Dow Jones only edged up 0.31%. Chip stocks played a huge role today, propping up the entire market. Before the opening bell, the CPI data for August was released. The numbers came in as expected, with US CPI growing 2.5% year-over-year, in line with forecasts and down from 2.9% in July, marking the fifth consecutive month of cooling inflation, the lowest since February 2021. On a month-over-month basis, it rose 0.2%, also as expected. The issue, however, lies with core inflation. Core CPI grew 3.2% year-over-year, again matching forecasts, but this was driven by stubborn housing inflation. The monthly increase of 0.3% was the highest in 4 months, surpassing expectations of 0.2%. The stickiness in core inflation diminished the likelihood of the Fed cutting rates by 50 basis points next week. Fed commentator Nick Timiraos from The Wall Street Journal mentioned that while the trend of easing inflation does pave the way for the Fed to begin lowering rates, the unexpected rise in housing costs makes a larger rate cut less likely. So, expect the Fed to stick with a 25 basis point cut next week. Initially, when the data dropped, market sentiment soured. S&P 500 and Nasdaq futures both dipped, and although they recovered slightly before the opening bell, the indices fell sharply after markets opened. The S&P dropped more than 1.6% at one point, hitting a low of 5,406. This 5,400 level has been a strong support recently, and the index bounced back after hitting it. Frankly, I was speechless at this dip. It felt like a deliberate shakeout to scare investors. The CPI data itself was fine, matching expectations. Analysts were cautiously optimistic at first. A 25 basis point rate cut has already been priced in by the market, but some investors, hoping for a larger 50 basis point cut, have been hyping this possibility, fueled by weaker employment data. Today's CPI, however, clearly supports only a 25 basis point cut in September, leaving these more dovish investors disappointed. They seem frustrated by the Fed's slow pace, fearing it may lead to a recession, hence the post-open sell-off. It's the same logic as yesterday's drop when concerns about weak global oil demand hit the indices. Thankfully, around 11 a.m., Nvidia bulls swooped in and lifted the market. On a day like 9/11, a symbolic day for America, it's almost like the stock market had to showcase US strength. When the market was falling this morning, I was shocked that the bulls didn't step in sooner. Yesterday, I even put together a cover expecting another potential downturn, but in the end, I was surprised once again. I knew we'd see gains today, but I didn't expect such dramatic moves. The market pulled off a perfect V-shaped recovery, a deep dip followed by a powerful rebound, which seems fitting for the symbolism of 9/11. Since the rebound began on September the 9th, market movements have been anything but smooth, with wild intraday fluctuations. Traders have no doubt felt this volatility firsthand. This constant switching between soft landing and recession fears shows that neither the bulls nor the bears have much confidence. After 2 failed attempts by the bears to push the S&P below 5,400, the bulls finally managed a strong rebound near the 100-day moving average. The tug-of-war over rate cut expectations will likely continue until the Fed's decision next week. Until then, expect the market to remain volatile. Institutions, after making moves in the first week of September, probably won't rush back into the market, so we may see more choppy trading in the near term. In my view, as long as we don't see a continuous sell-off before next Wednesday, the Fed will most likely opt for a 25 basis point cut. The QQQ broke above the 100-day moving average today, and if it holds above the 50-day moving average tomorrow, the rally could extend further. It seems that some funds are already buying the dip ahead of next week's rate cut, with volumes picking up, but given the uncertainty heading into October, the short to medium term remains unpredictable. I believe the real risk isn't before the rate cut, it's after. With no rate meetings scheduled for October, the market will be in a policy void. If the Fed only cuts rates by 25 basis points, the market will be more sensitive to economic data over the next month or so. Combine that with election uncertainties and potential quarter-end profit-taking, and stocks could face some pressure. The IWM Russell 2000 ETF briefly dipped below yesterday's low, leading many to think the chart was breaking down again, signaling a false bottom. But it turned out to be a bear trap. The stock rallied strongly in the afternoon, and closed back above the 100-day moving average. Today's candle has a long lower shadow, further reinforcing the bottom signal. Small-cap stocks haven't seen much action this year, but small businesses have been eagerly awaiting rate cuts, much like the long anticipation for a hero to save the day. Now that the cuts are here, they're celebrating. Whether they continue to rally or fizzle out again remains to be seen. On the political front, yesterday's debate between Harris and Trump didn't seem to go well for Trump. Betting markets have raised their odds on a Harris victory, leading to a steep drop in Trump-related stocks. DJT fell more than 17.5% at the open, eventually closing down 10.5%. Another Trump-linked stock, Phunware, also dropped by 10%. Meanwhile, the solar sector, seen as benefiting from a Harris victory, opened higher and surged across the board. Based on these moves, traders seem to believe that Harris won the debate. If Harris wins the election, the U.S. stock market may face a bear market next year. She has proposed raising the capital gains tax from 21% to 28%, which would squeeze corporate profits. This could push major investors like Berkshire Hathaway to lock in profits before the law changes. While it's still early to make predictions, investors like Warren Buffett will likely take action ahead of time. After all, big ships are harder to turn around than retail investors' portfolios, where we can sell with a single click. Speaking of Buffett, this week he sold another $230 million worth of Bank of America stock. When asked why, even the Bank of America CEO admitted he didn't know and couldn't ask Buffett directly. Now, back to individual stocks. Nvidia surged 8% today, closely mirroring the QQQ as it broke above its 100-day moving average. There's resistance ahead at the 50-day and monthly moving averages, but Nvidia was the big mover today, lifting the entire market. Meanwhile, Palantir saw a small gain as it continues to rally after joining the S&P 500. Its co-founder, Peter Thiel, plans to sell nearly $1 billion worth of stock, and although he filed this plan back in May, I wouldn't blame him for selling now. Palantir's stock is up 62% since his last sale in May. If I were in his shoes, I'd cash in too. Better to sell while the market's hot rather than waiting until it cools down. Finally, GameStop shares tumbled 12% today after Q2 revenue fell 31%, coming in below expectations. Despite turning a profit, the company hasn't held earnings calls in several quarters, leaving investors uncertain about its future. Thank you for watching today's market update. For more insights and daily stock market analysis, don't forget to subscribe to our channel and turn on notifications. Share this video with others who might find it helpful, and leave your thoughts or questions in the comments below. See you in the next update.